You signed for the house in 2021, $400,000 loan, 30-year fixed at 2.65%, monthly payment $1,600. 2 years later, the Federal Reserve raises one number 11 times, same house, same loan amount, monthly payment now $2,800, $1,200 extra every month, $14,400 extra every year. The house didn't change, you didn't change. One number changed, the same number that decided whether the tech company you work for was hiring or firing, whether your savings finally paid you, whether the country you live in was solvent. To understand why one number does so much work, start with what it actually is. The federal funds rate is the interest rate at which U.S. banks lend overnight reserves to each other. It is set by the Federal Open Market Committee, 12 voting members, 8 meetings per year, 7 Federal Reserve governors, plus the president of the New York Fed, plus 4 of the 11 other regional reserve bank presidents on a rotating basis. The decision is announced at 2 p.m. Eastern on the second day of each 2-day meeting. The economy reacts in milliseconds. That single number cascades through every other rate. Mortgages anchor to it through Treasury yields. Auto loans anchor through credit spread mathematics. Credit cards float directly with it. Savings accounts move within weeks. Corporate borrowing costs reset on every issuance. Stock and bond prices reprice continuously because every asset is, at root, the present value of expected future cash flows. And the discount rate that does that math is anchored in this number. The transmission is fast. The transmission is everywhere. Between March 2022 and July 2023, the Federal Reserve raised the Fed funds rate by 5.25 percentage points. 11 hikes in 16 months, the fastest tightening cycle in 40 years. Then starting in September 2024, it began cutting again. 3 cuts in 2024, 3 more in 2025. 8 times a year, 12 unelected people decide one number. The number rewrites the rest of the economy. On paper, the case for a small group of unelected experts setting one rate makes sense. 5 clean arguments line up behind it. The price stability argument. Uncontrolled inflation destroys savings, destabilizes planning, and disproportionately harms low-income households. A central bank with a clear 2% inflation mandate is the historically tested mechanism. Argentina, Turkey, and Venezuela are the counterexamples. The inflation rates there speak for the central bank model better than any economist could. The crisis response argument. In March 2020, the Federal Reserve cut from 1.75% to 0 in 14 days, deployed $2.3 trillion in liquidity. The financial system did not collapse. In 2008, similar actions broke the spiral of the financial crisis. Speed of response is what makes this work. The dual mandate argument. Under the Humphrey-Hawkins Act of 1978, the Fed has a legal mandate to balance both maximum employment and stable prices. Lowering rates is one of the only effective levers to accelerate hiring during a recession. The independence argument. Central bank independence from elected politicians is empirically associated with lower long-run inflation and more stable growth. Politically controlled central banks consistently underperform independent ones. The transparency argument. The modern FOMC publishes statements, projections, and minutes. The chair holds press conferences after every meeting. It is more transparent than virtually any other major central bank. 5 arguments, none of them wrong. This episode isn't an indictment of the Fed or of monetary policy or of the model. It's a structural observation about a specific gap. The gap between the popular framing, the Fed raises rates, and the structural reality that one number, set by 12 unelected people 8 times a year, quietly rewrites every household, every business, and every government on Earth. Picture 4 cases, same one number, 4 very different outcomes. Case A, your mortgage. The 30-year fixed mortgage rate hit 2.65% In January 2021, the lowest in U.S. history, by October 2023, it was 7.79%. On the same $400,000 loan, monthly payments went from $1,613 to $2,879, $1,266 more every month. Existing home sales fell from 6.1 million annualized in January 2022 to 4.07 million by October 2024, lowest pace since 1995. Roughly 80% of U.S. mortgages are at rates below 5%. Their owners cannot afford to move. The housing market locked. Case B, the tech layoffs. When Fed funds was effectively zero from 2020 to 2022, tech companies could borrow cheaply and grow at a loss. Investors paid 50 times revenue for the promise of future profits. Profitability was optional. When Fed funds reached 5.25% in mid-2023, the math reversed. The discount rate that converts future cash into present value rose. Tech valuations compressed sharply. Venture funding dried up. The labor adjustment followed. Twitter cut roughly 75% of its workforce in October 2022. Meta, 21,000 jobs across 2 waves. Amazon, 27,000. Google, 12,000. Microsoft, 10,000. Salesforce, 8,000. Industry tracker layoffs.fyi counted approximately 579,000 tech layoffs in 36 months, the largest sector-specific labor contraction since the dot-com bust. Cause: one number went up. Case C, your savings account. In early 2022, high-yield savings paid roughly 0.5% annual yield. By mid-2023, top accounts paid 5%. For the first time in over a decade, savers earned a positive real return to about 2% above inflation. But during the high inflation months in the middle of 2022, when consumer prices peaked at 9.06% and savings still paid 1%, savers watched purchasing power erode by 5 to 7% in real terms. Rate hikes protect savers. Rate cuts erode them. Most U.S. households are simultaneously borrowers and savers, and the rate cycle rotates which side of their household ledger is winning. Case D, sovereign debt. When governments borrow heavily during low-rate periods, they lock in cheap costs. When rates rise, refinancing gets brutal. Greek 10-year bond yields rose from 5% in 2009 to 48.6% at the peak of the 2012 crisis. Sri Lanka declared its first ever sovereign default in April 2022 as Fed rate hikes strengthened the dollar and crushed emerging market borrowers. The U.S. itself, federal interest payments rose from $352 billion in fiscal 2020 to $881 billion in fiscal 2024, a 150% increase in 4 years. Interest payments now exceed the entire defense budget. 4 cases, 1 mechanism. Move the rate, everything else moves with it. Most people picture monetary policy as a boring technical question. Bankers and bureaucrats arguing about basis points. Sometimes it is. Underneath that, the framework is older than the Federal Reserve itself. In 1898, Swedish economist Knut Wicksell drew a distinction that still anchors central bank doctrine. There is a market rate of interest, the rate banks actually charge, and there is a natural rate, the rate at which planned savings equal planned investment. When the market rate sits below the natural rate, money is too cheap. The economy overborrows, inflation builds. When the market rate sits above the natural rate, money is too expensive, investment freezes, deflation threatens. Every modern Fed chair operates inside Wicksell's framework. Powell, Yellen, Bernanke, all explicitly reference neutral rate, estimates that come straight from this 19th century insight. In 1963, American economist Milton Friedman wrote a book proving the Great Depression was caused in significant part by the Federal Reserve's contraction of the money supply between 1929 and 1933. Friedman's most quoted line from the same year: "Inflation is always and everywhere a monetary phenomenon." Translation: control the money supply and you control inflation. The lever that does this is the Fed funds rate. In August 1979, a man named Paul Volcker became Federal Reserve Chair. U.S. inflation was running near 12% and rising. Volcker had Friedman's framework. He decided to use it. Between 1979 and 1981, the FOMC under Volcker raised the Fed funds rate from about 11% to a peak of 19.1% in June 1981. Most aggressive monetary contraction in modern U.S. history. The consequences. Inflation fell from 14.8% in March 1980 to under 3% by 1983. Unemployment climbed to 10.8% in late 1982, highest since the Great Depression. The recession, lasting from July 1981 through November 1982, was the worst since World War II at the time, but the inflation broke. Volcker proved Friedman's theory using Wicksell's framework. The textbook stopped being theory and became operational. The rate is the lever. The rate is the price of money. Move it, and the rest of the economy follows. This episode is sponsored by my own private community. If reading the Fed like an operator made you want to go deeper into how monetary policy actually transmits, this is built for it. A community where I work through over 100,000 deep dive breakdowns, how rate moves propagate across asset classes, how the discount rate on cash flows math actually reprices markets, how the FOMC dot plot is read by professionals. Link is in the description below. All right, back to the diagnosis. Once you see the mechanism, the rest of the story is what one rate did across 2020 to 2025. At the level of one household, a representative U.S. family with a $400,000 mortgage refinanced at 3% in 2021, $100,000 in tech-heavy retirement holdings, and $20,000 in high-yield savings. The 2022-24 rate cycle did the following. The mortgage stayed cheap, but moving became unaffordable. The new rate would add $975 per month for the same loan. The tech-heavy retirement holdings fell about 33% in the 2022 NASDAQ drawdown, a paper loss of roughly $33,000. The savings account paid $2,000 more in interest over 2 years than at the prior rate. Net for this household, about $10,800 worse off per year, dominated by the housing market lock-in. At the level of the corporate sector, S&P 500 corporate interest expense rose from approximately $520 billion in 2021 to $770 billion in 2024, a 48% increase in 3 years. Investment-grade issuers saw their average new issue coupon rise from 2.5% to 5.5%. Every dollar of debt rolled over became more than twice as expensive at the level of the federal government. Federal interest payments, $352 billion in fiscal 2020, $881 billion in fiscal 2024. The Congressional Budget Office projects $1.7 trillion per year by 2034 if rates stay near current levels. For perspective, the federal interest payment in 2024 already exceeded the entire defense budget. Each 1 percentage point increase in average effective interest rate adds about $290 billion to annual federal interest cost at current debt levels. The aggregate U.S. debt service burden, household plus corporate plus federal, moved from about $2.1 trillion per year in 2020 to roughly $3.6 trillion in 2024. That's a $1.5 trillion transfer per year from borrowers to lenders, recurring annually for the duration of high rates. The Fed funds rate moved from 0 to 5.25%. The math followed. Once you see the mechanism in full, the Fed funds rate stops being a number on a screen. It starts being the most important price in any modern economy, the price of money itself. A rate is the price of borrowing the future today. A rate is the discount factor that converts tomorrow's expectations into today's prices. A rate is the speed governor on the entire system. Pressed gently, the economy goes faster. Pressed hard, the economy slows. Pressed too hard, the economy crashes. Not pressed at all. Inflation eats everyone equally. For an individual participant, this means three things. There is no exit from the rate. Every asset you own, every liability you carry, every dollar of income you earn, every year of retirement you plan for, all of it is priced through this single number set 8 times a year by 12 people, almost none of whom you have ever heard the name of. There is no clean side. Rate hikes squeeze borrowers and reward savers. Rate cuts squeeze savers and reward borrowers. Most U.S. households are simultaneously both. Whichever way the FOMC moves, half your balance sheet wins and half loses. There is no policy that addresses both halves at once. The Fed's mandate is balance. Balance in practice means trade-offs that nobody asked you about. That doesn't make the system illegitimate. The Fed was created by Congress in 1913, given its modern dual mandate in 1978, and operates with explicit congressional oversight. The independence is by design rather than accident. But the citizen's blind spot is real. Most people can name their mayor. Most can name their senator. Almost none can name 3 voting members of the FOMC. The decisions that move their lives most are made by people they have never voted for, in a building most have never seen, 8 times a year, on a schedule that does not consider their personal balance sheet. Recognition of which rate is doing what to which part of your wealth is the first move. 3 operational rules to take from this. Rule 1. The rate is a regime, not an event. Rates don't move in single decisions. They move in cycles. From 2022 to 2023, 11 hikes in 16 months. From 2024 to 2025, 6 cuts. The cycle is the unit of analysis. When the FOMC begins a hiking cycle, every borrower expects to refinance into higher costs, and every saver expects to be paid more, and vice versa for a cutting cycle. The single decision matters less than the trajectory. Rule 2. Read your balance sheet through the lens of duration. Long duration debt, a 30-year mortgage you locked at 3%, is a one-way bet that gets more valuable as rates rise. Long duration assets, your tech stock portfolio, your future cash flows from a startup, the present value of your career are the inverse. They lose value as rates rise. Most household balance sheets are mismatched. A clear inventory tells you which side of any rate cycle you sit on. Rule 3, the FOMC speaks. Listen to what it says, not what it just did. The Fed publishes the summary of economic projections, the dot plot, at 4 meetings per year. Members publicly describe what they see. The path of future rates is mostly observable in advance for anyone who reads. That information is free. It moves trillions of dollars in markets within seconds of publication. For an individual, it tells you the regime you are pricing into. These are operational rules, not philosophical ones. They don't fix the system. They give you a way to live inside it without the rate cycle running over you. You signed for the house in 2021, same house, same loan amount, $1,200 extra per month after the FOMC raised one number 11 times, 8 billion people now wake up every morning inside a system whose price of money is decided 8 times a year by 12 people they have never voted for. It isn't a conspiracy, it's a structure. Wicksell drew the framework in 1898. Friedman explained the mechanism in 1963. Volcker proved it on the ground in 1981. If you want more breakdowns like this, so subscribe. There's a lot of math worth understanding. Numbers don't lie. But they don't explain themselves either.